The first idea is that income is an asset. Salary, bonuses, commissions, freelance revenue, rent, dividends, interest, and business cash flow all feed the household account. Investment assets can be diversified, but income assets also need a concentration check. If spending, debt payments, insurance, saving, and investing all depend on one paycheck, that paycheck is the largest single asset on the family balance sheet. It may not have a market price on a brokerage screen, but it supports the entire planning system. The second idea is that income risk is not only unemployment. Income can fall because of layoffs, industry cycles, automation, commission changes, platform rules, health problems, caregiving needs, or fewer working hours. A job that feels secure today can still have hidden fragility. The practical question is not only whether you have a job today, it is what happens if income falls by 30%, 50%, or pauses for 6 months. The third idea is that side income is not magic. A side project can consume time, create tax and compliance work, interfere with the main job, require capital, and produce very little cash at first. Income diversification does not mean doing more random things. It means making income sources, skills, clients, and choices less fragile. A bad side hustle can add risk instead of reducing it, so the map should come before the idealist. Start with the main income map. Write down employer, role, industry, income mix, fixed and variable pay, bonus dependency, location, required credentials, and key skills. Then ask 5 questions. Is the employer stable? Is the industry cyclical? Can the role be replaced or automated? Is income tied to one client or one platform? If you leave the current employer, can the skill transfer elsewhere? These questions are more useful than a generic list of popular side businesses. The next map is skill capital. A skill is not a resume adjective. It is an ability that can be converted into market value. Separate skills into 3 layers. Layer 1 is what the current job requires. Layer 2 is what transfers within the same industry. Layer 3 is what transfers across industries. The most concentrated worker may be strong in Layer 1 but fragile outside the current seat. Then map income types. Base salary, year-end bonus, commissions, freelance work, teaching, consulting, content, rent, dividends, and interest have different behavior. Some are stable but slow growing. Some are volatile but teach valuable skills. Some look passive but require maintenance. The goal is not to collect every type. The goal is to understand risk, cost, and evidence for each type. Time concentration matters too. Time is capital. If all useful hours are consumed by the main job, commuting, exhaustion, and household duties, there may be no room to build a second option. In that case, the first step may not be a side business. It may be reducing fixed expenses, improving work processes, protecting study blocks, or lowering stress so there is room to experiment. Cash buffers create room for income diversification. Emergency reserves protect against income interruption. Career transition capital supports learning, certification, job search, portfolio building, or a low-cost market test. These 2 buckets should not be confused. Emergency reserves help the family survive. Transition capital helps future income become more flexible. If the emergency reserve is spent on an experiment, the household has reduced its safety before the experiment proves anything. Run an income stress test. If main income falls by 30%, what is the monthly shortfall? If bonuses disappear for a year, how much does the saving rate fall? If a job change takes 6 months, how long can the household support required expenses? If a side project earns nothing for half a year, does it threaten mortgage payments, insurance, or education costs? Stress testing makes choices visible before pressure arrives. Income risk must be read together with spending structure. The higher fixed spending is, the more fragile one income source becomes. Mortgage payments, car loans, insurance premiums, tuition, family support, subscriptions, and lifestyle commitments all reduce flexibility. Some households do not need a side hustle first. They need lower fixed commitments, so temporary income volatility is survivable. Lower fixed costs can be a form of income risk management. Skill investment needs in order. First, strengthen the skills that protect the current job or improve bargaining power. Second, build skills that allow movement within the same industry. Third, build cross-industry skills such as data analysis, communication, sales, financial literacy, project management, writing, or language ability. Fourth, test an income model that can turn the skill into cash. If the order is reversed, the household may buy busy work instead of resilience. Do not turn learning into consumption. Courses, tools, and communities are useful only if they produce output, feedback, or measurable capability. Skill capital investment should answer three questions. Does it reduce unemployment risk? Does it improve salary negotiation or job mobility? Does it produce a portfolio, service, credential, or result that the market can evaluate? Without those answers, learning may simply be anxiety with a receipt. Side income testing should start small. The first experiment should not be quitting a job or buying expensive equipment. A better 90-day test creates one deliverable, a consulting offer, a small workshop, a portfolio page, a customer interview process, or a service package. Until there is evidence, the side income should not be counted in the household budget. Evaluate a side income idea with 5 measures: downside loss, time load, learning value, cash conversion speed, conflict risk with the main job. If an idea has low income, heavy time demand, little transferable learning, and possible employer conflict, it is not diversification. It is new concentration in exhaustion. A useful experiment should at least produce a skill, a portfolio item, a client conversation, or a clearer market signal. Platform income needs caution. Content platforms, commerce platforms, freelance marketplaces, and delivery apps can help people start quickly. But rules, traffic, fees, account risk, and competition are not fully controlled by the worker. A platform is useful as a testing ground. It should not become the only income source that supports fixed household spending too early. Platform income needs its own risk map. Networks are part of income risk. If all opportunities come from one employer, market information shrinks after leaving. Weak ties, industry peers, former colleagues, client relationships, and visible work can increase career optionality. This is not manipulative networking. It is reducing dependence on one gatekeeper for information and opportunity. Many good opportunities appear through trust before they appear as public job posts. Income diversification and investment allocation should be viewed together. If job income is already tied to technology cycles and the portfolio is also concentrated in technology stocks, the household has double exposure. If income depends on real estate and investments also depend on real estate, the same shock can hit both sides. Human capital belongs on the same risk map as financial assets. Insurance and emergency reserves are the floor, not a replacement for skill development. Disability, serious illness, accidents, and caregiving can interrupt income suddenly. Appropriate insurance can transfer part of a severe risk, and reserves can buy time. But they do not replace long-term skill renewal. Defensive protection and offensive skill investment serve different roles. Without the defensive floor, every experiment becomes higher pressure. A 90-day action plan can be simple. In month 1, map income concentration, fixed spending, and skill gaps. In month 2, choose one high leverage skill or mobility asset and create visible output. In month 3, run a small market test, 3 potential customer interviews, 10 focused job applications, 1 portfolio page, or 1 paid trial. Every step needs evidence, not only intention. Evidence tells the household whether to continue, adjust, or stop. Do not chase popular side hustle lists. Another person's idea fits their skills, time, capital, and risk tolerance. It may not fit yours. If your income map shows that core skills are aging, skill renewal comes first. If fixed spending is too high, flexibility comes first. If you already have strong skills and spare capacity, then a small monetization test may make sense. Income diversification should start from your risk map, not from someone else's story. Household communication matters. Income diversification can affect time, cash, stress, and family routines. A partner or family should understand the experiment budget, maximum test period, stop conditions, emergency money that cannot be touched, and the line that protects the main job. Without shared rules, an income experiment can become household conflict. Financial resilience is a household system, not one person's performance. Every experiment should also have a stop condition. If you learn a skill, what visible output should exist after 3 months? If you test a service, how many customer conversations prove enough interest to continue? If you buy tools, how much money can be lost before stopping? Boundaries keep income experiments from consuming the cash and attention they were supposed to protect. The main job still matters. For many households, it remains the first and strongest cash flow engine. Income diversification should not damage professional reputation, violate employment agreements, or burn health. A resilient sequence is to strengthen the main job, build transferable skill, test one small second curve, and increase commitment only after evidence appears. That may feel slower, but it is closer to risk management. Review the income map quarterly. A new manager, a new company strategy, a weaker industry cycle, a larger mortgage payment, or a family caregiving need can change the risk picture. The goal is not constant anxiety. The goal is to know whether the household has more choices than it had last quarter. Turn the map into one decision. If the largest risk is employer concentration, update the resume, portfolio, and network before the job is in danger. If the largest risk is an aging skill, choose a learning project that creates visible proof. If the largest risk is rigid spending, reduce fixed commitments before adding a new experiment. Income diversification only becomes useful when the map produces a concrete next action. Small, measurable steps let the household improve flexibility without damaging the safety buffer first.